Kitco News special coverage of the New Orleans Investment Conference is brought to you by Uranium Energy Corp., Uranium Royalty, Gold Mining, and Gold Royalty Corp.
Hello, I'm Michelle Makori. This is Kitco News, and we are at the New Orleans Investment Conference now in its 47th year. And joining me here on set is Danielle DiMartino Booth, a former Fed advisor and insider, and currently the CEO and chief strategist at Quill Intelligence. Danielle, so nice to see you in person.
In person, this is wonderful. I'm starting to get used to this non-Zoom world.
Isn't it? It's a better world.
Refreshing, yes.
All right, well, Danielle, as a Fed insider, let's get some insight on the Fed, which seems to be in a very precarious position, arguably largely of its own making. Seems like the Fed is stuck between a rock and a hard place. And even Fed Chair Jerome Powell is now acknowledging that inflation is not so transitory. We heard from him recently saying that inflation will last well into 2022. He's putting the blame on supply chain issues. Powell still says, though, that the central bank is on track to begin reducing its purchases of assets. What do you think that means? What can we expect come November 3rd?
So I don't think the Fed has much of a choice. I think that the Fed would prefer to not have to act. It's fairly unusual for the Fed to make any major policy shifts when there are massive political events going on in the background, because it presents an image. It presents this idea that the Fed is trying to side with one political party or another. So if they tighten and they take the stock market down, are they trying to harm the Democrats? So for the Fed to shift policy right now is highly unusual, but by the same token, we have much more going on here than a supply chain disruption. And there's much more problematic forms of inflation that I don't think Jerome Powell is prepared to acknowledge, but it is the sticky types of an inflation that I think the Fed has to be most concerned with, and that really is beginning to bleed through into housing and rental inflation, and that will be something that sticks with the Fed beyond the supply chain disruption.
Do you think the Fed is actually buying the transitory inflation narrative that it's putting out there?
Oh, I think, I don't think most people inside the Fed believe in the transitory narrative anymore. I think most have been, well, the survivors who's left. But I think that most Fed officials at this point have acknowledged that the word transitory, as we came to know it growing up in school, as it's originally been defined, is certainly not transitory, that there's something much more persistent about this. And the Fed's idea that they're going to let inflation run hot, I don't think they were ever anticipating that it was going to run hot for this long.
Well, look, Powell is saying that if, and I quote, "were to see a risk of inflation moving persistently higher, we would certainly use our tools." At this point, what are the tools, and would they even be effective considering the inflation that we're seeing?
They do have tools to fight inflation. They can try and slow inflation down. They can tighten policy.
By raising interest rates.
By raising interest rates. They certainly can. But they're boxed in because the economy is already slowing. And so that is, they're either they tighten or they don't. Both are policy errors. Tightening too slowly, leaving interest rates too low for too long. I mean, we had a flash recession. That's what I call it, a flash recession. It lasted all of 2 months. So they've kept policy inappropriately too easy for much too long. And especially with the mortgage-backed securities purchases that have ignited a housing market that is now already slowing. We're seeing Boise, Idaho, one of the fastest, hottest markets in the country. We're seeing price reduce signs. We've seen 6 back-to-back months of falling car sales. Car sales don't fall for 6 months consecutively unless the U.S. economy is in recession. So and I understand that there's a semiconductor shortage and that the supply chain disruption has hampered auto sales, but there's something else going on beneath the surface, and that is that there's no more stimulus checks being written by Uncle Sam. So there's no more money being injected into the economy.
But there could be more money, not in the form of stimulus checks per se, but if this infrastructure bill in one form or another gets passed, that is going to inject the economy with a couple of other trillions. What impact would that have?
Historically speaking, it hasn't. If you look at the precedent of President Obama's infrastructure spending plan, it did a lot of nothing for inflation and for economic growth, for that matter. We're talking about bureaucrats here who are working with public unions and spending spread out over a 10-year period. That is nothing compared to giving households trillions and trillions and trillions of dollars directly.
Yeah.
And that's something that they can take immediately and go buy something with or go take a vacation. And that is what has really hypercharged inflation.
Yeah, and
that's
that's
how immediately the money was put into the economy.
And that's arguably what got the Fed into this position.
Right.
So now, as you say, damned if they do, damned if they don't.
Absolutely.
You've got rising inflation, an economy that's slowing down. Mm-hmm. So what happens next?
It'll be interesting to see. I think a lot of it's going to be contingent upon the midterm elections. What we've seen that's different, that distinguishes the great financial crisis and the response to the great financial crisis is that the Fed was able to go at it alone in 2009, 2010, 2011. This time, they needed fiscal money as well. And we're headed into midterm elections. And I think Washington, I think it's on full display, Washington dysfunctionality. And there's certainly no reason that the GOP would want to help the economy headed into 2022 and the November midterm elections. So the Fed might not be capable, and I've been emphasizing this, without a fiscal boost. The Fed might not be able to go at it alone if the economy does slow. And again, they're also tightening.
So do you think that they should be boosting things further, though, to counter the slowing economy?
I think quantitative easing is a known failed experiment.
Okay.
I don't think the money serves a true productivity increasing purpose. Going into the pandemic, we had 14% of U.S. companies were zombies. They didn't have the cash flow to cover their interest expense. Now we have 20% of U.S. companies that are zombies. Powell and what he did with the bailout of the corporate bond market didn't allow the weakest players, Schumpeter's creative destruction, he didn't allow that to happen. So now we have this deadweight in the economy, and all this quantitative easing has not produced productivity. Had we come out with massive infrastructure spending, and I'm talking about massively, $3-4 trillion, and put into the economy quickly and putting people to work quickly, instead, the combination of Fed policy and fiscal policy pulled people out of the workforce. And now we have small businesses especially suffering under the acute pressure of rising wages and not able to compete with some of the largest companies in America that do have access to the bond market thanks to the Fed.
So if the Fed does slightly begin to taper, and that's just reduce its asset purchases.
Just reduce the pace at which, and it's being said that might be $10 billion a month in treasuries and $5 billion a month in mortgage-backed securities. It's child's play. But it looks like, and if Jay Powell's right, that inflation is going to persist into 2022, it looks like they might have to compress this tapering process. Markets are not pricing that in.
Right. That was my next question. What happens when that begins? How do you see the markets reacting?
I don't think. Well, look, we have the playbook to go back and look at. We have 2018. We know that the stock market did not like it when global central bank liquidity turned negative in 2018. It ended with the Christmas Eve bloodbath of that year and triggered the Powell pivot, and effectively the Fed saying we weren't able to tighten, and yet it looks like they're going to be forced into this tightening, not just tapering, but actually raising interest rates. And markets will not like that.
Which sectors do you think will like it the least or will respond most unfavorably soonest?
So I think right now you're seeing consumer discretionary start to suffer because, again, I'll bring back those 6 back-to-back months, including October, according to Cox Automotive, of falling car sales. Big ticket durables. All of that spending was pulled forward by the stimulus. So people don't need to build another back deck. Yeah. The back deck is built. People don't need a third car. It's been purchased. People don't need to buy another new home. It's been purchased. They don't have to furnish another new home that they're not buying. So anything that's related to big spending, I think, is going to be in the crosshairs.
Consumer discretionary, especially. Yes.
And we saw this, by the way, the last time there was a debt ceiling standoff in 2011. Yeah. Discretionary suffered, the Russell 2000 suffered, and staples roared.
Are there any sectors that you think are better positioned to withstand this, or how would you play this looming taper tantrum?
So I think that there are certain areas where you can be defensive. Americans continue to age. And I think strong balance sheet healthcare companies are going to be a really good place to be. I think any company with a strong balance sheet and a dividend and the ability to generate cash flow is going to benefit in this environment, because people will look to those stalwarts that they know are going to be money good. Even if the price of the stock falls, they know that they're going to be compensated on the other end by a dividend, because that balance sheet's so strong.
All right. Well, in the meantime, Danielle, the Fed is dealing with some internal turmoil.
Just a few.
Just a few scandals.
Just a few scandals every day.
We know that the Federal Reserve has announced that it's now going to ban policymakers from owning individual stocks and restrict trading following some controversy with some Fed members.
And by the way, that was the policy when I had top clearance. That was the policy I had to abide by. So I'm kind of
So what happened?
I'm kind of tickled by the fact that they're reimposing strictures that already existed, at least when I was there.
So they sort of rolled those back and reimposed them?
It appears. I mean, it certainly appears to be the case. And you know, I think you have to be measured in how you judge some of these trades.
Yeah.
There's a big difference between Jay Powell selling an index fund.
Yeah.
After which time the index increases by 33%. There's a big difference between that and dear man, I like him, but the head of the Dallas Fed was trading individual securities in large size.
Yeah.
And that is not what you would consider to be kind of at arm's reach. So Kaplan, to me at least, really did cross a barrier in trading those individual stocks.
Well, now they seem to have reimposed regulations against doing that. And to your point, kind of figured that this would have already been in place. But does this help restore Fed credibility? Do you think that the Fed is at large facing a big credibility crisis?
I think, I definitely think that that's the case right now. You don't see this much, I mean, turnover and the Fed, the term turnover and Fed official, they don't tend to coexist. And yet we've seen three people very quickly leave the institution. Randy Quarles was head of banking supervision and regulation. So in many ways, I think that there's good reason to be concerned that there's not enough leadership right now at the Federal Reserve, especially in the event that if something was to go wrong in the financial markets. You have to remember that you've got a pure academic running the New York Fed. And with deference to John Williams, that's without people like Randy Quarles, knowing that Rich Clarett is going to be leaving, knowing that Jay Powell may himself be at risk of going back into the private sector, you're going to end up with too few people who have a decent appreciation for the plumbing of the financial system at a very vulnerable time.
Yeah, well, speaking of turnover, as you mentioned, Jerome Powell may not be Fed chair. He's up for nomination or not nomination come February. We have several very loud Democrats calling for him to be removed. Senator Warren, Congresswoman Alexandria Ocasio-Cortez, really pushing Biden to not renominate Powell.
Progressives are very vocal.
Very vocal and very aggressive. And they're contending that the Fed should be doing more to advocate for climate change, to advocate for diversity. They're really changing the mandate of the Fed from being apolitical to pushing for very political issues.
Highly inappropriate. Highly, highly, highly inappropriate. What they're trying to push the Fed to do, if Elizabeth Warren had her way and Brainerd, who can't be confirmed, by the way, I don't think the Senate's prepared to get 60 votes in favor of Lael Brainerd, because I think that there are enough from both parties. I think that there are enough who recognize the slippery slope of an advocate for a central bank digital currency.
Right.
And you're talking about reopening the Federal Reserve Act of 1913. If you're going to have the ability for the Fed to directly inject money into people's individual bank accounts effectively.
Let's circle back. Let's break that down a little bit more for our viewers. So if Powell does not get nominated, there's about a 23% chance favoring Lael Brainerd as the next candidate. Do you think she will be nominated by Biden?
I think that the reason that we haven't heard from the administration is because this is such an existential question right now. There is such risk of change being something that upsets the stock market. And I think that Biden's reticence is is twofold. He knows that Powell will get easily reconfirmed, easily.
Okay.
Slide right through the Senate. And he knows that Powell will also be a calming agent for the stock market, which right now is not in a place where it's going to welcome any major changes.
Well, I mean, we know that Obama kept Bernanke, who was nominated by Bush, mostly to keep the peace and keep a smooth transition during the financial crisis. So it's not unheard of for a Democrat to stick with a Republican nominee. Very, very recent history has indicated that
absolutely
it does happen and can work. But assuming Biden doesn't go in the way of Powell, who's the most likely candidate then?
When you look at predictit.org, which is what I follow, obviously you follow it as well because you've got the latest.
The 23%.
The 23%. And Powell's up there with 72 or 73% at the moment. The fact that there's nobody else in the running indicates to me that it would be somebody who's not even in the discussion right now. That it would be a complete and different outsider. So
how would the market react to that?
Depends on who it is.
Right. I suppose, good point. Well, I guess just the element of an uncertainty, which markets we know do not like uncertainty.
They don't. And I think that markets would applaud somebody in Jay Powell's spirit, who is not a PhD in economics,
right,
who does have experience in the financial markets. We forget that Steve Mnuchin, for the scandals and the money that he may or may not have made in an untoward fashion in the subprime crisis. But we forget that somebody who was very adept and had a good understanding of the financial markets was at the helm of the Treasury Department when financial markets became very disrupted in 2018 and 2019.
Right.
Well, I don't know that we can say the same right now of Janet Yellen. And if you were to have an academic running the Fed as well, I think the markets would be very nervous.
Well, let's circle back to what you mentioned about central bank digital currencies, because Fed Reserve Governor Lael Brainard has been very vocal in favor of them. Jerome Powell has indicated a more cautious approach. He's indicated that they would need congressional approval.
They would.
Brainard wants to really push ahead with this issue. She maintains that the U.S. cannot lag behind China. You're saying that that is one of the issues that may prevent her from getting congressional approval as Fed chair?
It's the same argument that you're seeing play out with the proposed $6 trillion and then $3.5 trillion and now $1.5 trillion spending bill. You're talking about the same exact issue here, and that is the march of the progressives. I call them the regressives. But that is how people in Congress view a Brainard versus a Powell. One holds the line, one doesn't. There's a good point to be made about playing defense as a sovereign nation in the event that China succeeds in imposing its own central bank digital currency, which it's trying very hard to do. So there is something to be said for making sure that we are also capable to be digitized, but we've been transacting digitally for how long? So all you have to do is have your phone on you now.
Yeah, well, the Fed coin, or the central bank digital currency in the form of the dollar,
that's different.
That would allow the Fed to have complete control over every transaction in the monetary system, complete elimination of privacy, can track every cent and every dollar, and most disconcertingly to people, may phase out cash, not in the near term, but in the long term.
Well, yes, and you've heard individuals such as Kenneth Rogoff say that in order to make this transition as a nation, that you would penalize people if they held cash. When similar activities were undertaken in Japan, in Tokyo, the number one selling item was home safes, because people were literally putting their yen inside of a safe and keeping it. And so you always end up with a negative consequence, with a backlash effect and a backfire.
But do you think that whether it's Brainard or not, that the U.S. could be moving in the direction of a central bank digital currency, that Fed coin is in our future?
I think that if you're asking me why Congress has a 13% approval rating, it's because when push comes to shove, all of a sudden they do stupid things. So I think if the economy was to slow enough, I think most in Congress would vote for anything.
Why would a CBDC encourage economic growth? Why would that be some sort of solution?
That's the theory, is that you get money directly to the people. But we've taken that theory, as I was just saying on stage, we've taken the theory of of giving people money directly for a test drive. We had 3 stimulus checks, many of which went to families who didn't need it at all. And what we have in exchange for that is inflation. And that, again, is the slippery slope of socialism itself and making the Fed capable of delivering money directly to people. If you think 5% inflation is what you have today after 3 stimulus checks, start giving people money directly on a regular basis, we will have runaway inflation.
Well, you could say, what's really the difference between depositing it directly into their bank accounts, or for the few that need to collect a paper check, as opposed to...
But they would all be there. All Americans would go on that platform.
Yes.
Right? You would make redundant the entire conventional banking system, which again
in itself would cause havoc in the financial sector.
Absolutely. And that's why I think that when you circle back to the idea of Brainerd being confirmed, it's so difficult. Because there is a massive lobbying concern, and there are special interest groups who are saying, draw the line. You can't put the conventional banking system of the United States out of business in order to reach the unbanked. There are other ways of going about this. And I appreciate the plight of the unbanked. I appreciate the fact that overdraft fees, for example, are too high, and that all Americans should have access to banking. But this is not the way to go about it.
So what do you think the odds are that there will be FedCoin? That
I think
sanity will not prevail?
I think that it's going to depend on the complexion of the next downturn in the U.S. economy. And if it's anything of the magnitude of the crisis or of the post-pandemic flash recession that lasted for all of 2 months, again, Congress cannot be trusted to not put bad laws into the U.S. economy. And you never undo these programs. Once the spending begins, it never ends. The programs are never temporary in nature.
But arguably, FedCoin would be beyond just spending and beyond just stimulus, because it would completely change privacy in financial transactions. When the government is able to monitor every single dollar and cent spent, and can, if we look at how China proceeds, take people out of the system that don't play by the rules, it's not in the spirit of how America is run or should be run.
It's absolutely anti-American.
And yet you think it could happen.
And yet I think it could happen.
Well, that is a very sobering note, Danielle.
Jay Powell has always said, and I don't give him a lot of credit after he bailed out the corporate bond market. I'm still a little bitter about that. But Jay Powell has always maintained that if there was to be a central bank digital currency, that it would be just as anonymous in nature as the dollar bill in your wallet. And that is why we need to have advocates in that vein, in that spirit, in leadership positions at the Fed to hold this line.
What would FedCoin mean for gold and for Bitcoin? We'll start off with gold.
I think for both, it would represent a safe haven, a place to go and hide.
You mean going into gold and going into Bitcoin?
I think people would look for shelter.
Do you think that it would mean that Bitcoin could be outlawed?
I think the jury is out on Bitcoin until not just U.S. regulators, but there is a global regulatory framework that addresses Bitcoin on an international level. And until that regulatory framework is put into play, I don't think you can determine what the ultimate fate of Bitcoin is.
So you still think that Bitcoin has risk of an existential crisis risk?
I think that Bitcoin can be taxed.
Yeah, we know that.
So it depends on the size of the tax, and it depends on the ability. Again, we haven't seen major regulatory moves in cryptocurrency because the regulators are trying to get their heads around it themselves.
Yeah.
So it's something that exists. As John Najarian was just saying a few minutes ago, if you really want to get rid of cryptocurrency, you're going to have to shut the internet down worldwide. Just poof, there goes the internet, because it's very difficult. And I think that is the struggle right now among regulators.
All right. So very quickly, how are you positioning yourself, or how would you advise our viewers to position themselves for this doom and gloom scenario?
I laugh because I think back to years ago when I was on stage with Richard Fisher, and I asked him, I said, so how is your portfolio positioned? And he said, it's in the fetal position. So it was one of the best lines I've ever heard. I had to steal it. It's a good line. I am aggressively holding on to my gold. I do like the fact that I have a lot of real estate. My municipal bonds have treated me very well. I think the United States government has already proven that the state of Illinois and New Jersey, they're still in existence. They're not bankrupt. So I think munis are also a good place to hide in the interim.
But what about inflation? How do munis withstand inflation?
Well,
We've had guests here saying, get out of bonds, all bonds are bad.
I don't think that we necessarily have the type of inflation that should worry, because we're seeing the 30-year long bond be very sticky where it is. We're seeing a flattening between the spread of the 10-year Treasury and the 30-year Treasury. That indicates to you that the economy is slowing. So even as the Fed tries to raise interest rates, they could still be facing an inverted yield curve,
right,
which would provide protection for longer maturity bonds.
Okay. Well, Danielle, thank you so much. Really appreciate your insight and analysis. Thanks for joining us, and nice to see you here in person.
Nice to see you in person. Thank
Danielle
you for having me.
DiMartino Booth, appreciate it.
Kitco News special coverage of the New Orleans Investment Conference is brought to you by Uranium Energy Corp, Uranium Royalty, Gold Mining and Gold Royalty Corp,